everyone. My name is Jire. I'm a forex trader and I've been trading forex for about 5 to 6 years now. I would like to talk about something very important and I would like you to pay attention. But before I continue with my video, I would like you to like this video. Just push the button below and subscribe so that you can get more videos that I may be sharing in the future. For you to learn in this forex market. So I'll quickly go to the reason why I'm making this video right away. A lot of people have been asking me questions in the course of my training forex. In some of my classes, our mentorship classes, and one of the questions that usually come is, how do I really enter a trade? I would like to say something. If you really want to be a good trader, if you really want to be a successful trader, if you want to actually increase your probability of winning and increase your win ratio, you must learn two things. You must understand, the rhythm of the market. Somebody cannot be playing, a musician cannot be playing pop music and then you are dancing high life. It's not going to work. That is with dancing up it, and that's what a lot of traders do. But if you understand the rhythm of the market, your life becomes easier. How do I mean by the rhythm of the market? How does the market move? A lot of people talk about technicals, we talk about fundamentals, we talk about unusual activity and events in the market that can actually change the direction of the market. But trust me, if you can actually apply your understanding of how the market really moves and apply proper risk management to your trading, and on top of all of that, you can layer patience on it. You will always win in the market. So today I'm going to be talking about how to get a good entry in the market. So one of the things I'm actually going to be talking about basically is what are those things you really need as a tool, as a professional trader this time around, even intermediate. You don't need to be a professor of trading before you make money in the market. Just have a trading plan, have a rule, look out for some of those things, define some of those things you really need to see in the forex market before you actually enter a trade. Then don't follow the bandwagon. It's possible for everybody to be in the wrong direction and they are the only one that is right, because what you are seeing is totally different from what others are seeing. Obey your own rule, understand what you are doing in the market, and you will always win. So today I'll be talking about high probability trade entries or high probability trade entry sequence in the forex market. For me to be able to do that, I'll be touching on a number of topics, and then once I explain each of these topic items, then I can come back and explain to you how to use all of this knowledge that I've highlighted here, to win in the forex market. So the first thing I'm going to be talking about is the market structure. And when we talk about market structure, we always talk about this direction of the market, or what price is actually doing at a particular point in time. And there are three major things that the market or price will always do. Number one, the price can always be in an uptrend, or secondly, it can be in a downtrend, or price can be moving sideways, or what some people will call a ranging market. So we have three types of market, generally speaking. We have an uptrend, we have a downtrend, and then we have a ranging market. The second thing I'll be talking about, that is going to be important for you to know, which is one of the major institutional reference points in trading, is what we call order blocks. And there are two major types of order blocks. We have the bearish order block and we have the bullish order block. Now, what a lot of traders do not know is that it is not every order block, be bearish or bullish, that is valid for trading. But I'm not going to be talking about that today. I'm going to be making a totally different video to show you how to identify a valid bearish order block or a valid bullish order block. It is important for you to know if you want to continue to win or have a high rate of win or have a high winning rate in this market. The next thing I'm actually going to be talking about is fair value gap. What is fair value gap? How can you spot fair value gap in the market? I'm also going to be telling you a situation whereby you see all the blocks and fair value gap, which one takes preference over the other. One of the things I can say, even though I'm not trying to to talk about a valid order block, is that anytime you see an order block, that has a fair value gap close to it or embedded in it, that order block is very valid. Now, the next thing I'm going to talking about is change of character, break of structure. A lot of people still get confused about what a change of character is and what a break of structure is, and a number of times these two get mixed up. Yeah, they are similar, but I need to warn that a change of character is not particularly a break of structure. You get to understand that better. And lastly, I will be talking about some examples, maybe just one or two examples, if time permits me, based on the time allotted for this recording, to actually do more example, and probably just do one for a bullish market and one for a bearish market. So without wasting so much time, I will take them one after the other. I will first of all talk about what we call an uptrend. Now look at the pattern that I just brought forward now. Now, what you will see is that this market is actually in an uptrend. Why do I say in an uptrend? For those of us that understand Forex, basically, you will see that this market is actually moving in an upward direction. The market started from this particular point here and then move upward, retrace downward, and then move upward, retrace downward, but in an upward manner. And this is what is called an uptrend in the Forex market. Now, the major thing you need to know is that whenever you see the market, starting from a low, just like this, you see the market starting from a low, you see a low, and then you see a high. And then you now see another low, but not, getting to the previous low, or that you see another low that is higher than the previous low. That is, for instance, if price here is at 1, and then it got to 10, and then it came down, it didn't get back to 1, but stopped at 4. That means that, it made another low after making a high, but that low did not get to the previous low. Then you call that a higher low. Now, what you will see here is that the market, actually broke that previous high and then made another high. Now, but what you will see here is that this previous high is not as high as the current high, meaning that the current high is higher than the previous high. In that kind of situation, you will say this is a high, but it is a higher high because simply it is higher than the previous high. Now, you see the market make another upward move, breaking the previous high. Now, the market has made another high, but it is higher than the previous high that was made, earlier on. Now, what you saw the market did here was to break, this previous high upward and came back down, and then made another move upward and created another high. After that, the market also broke up, and then the previous high, 2 highs have been broken here actually, another high got broken here actually. Now when you start to see this kind of movement in the market, then you will say the market is uptrending. This is a simple example of what an uptrend is all about. So I don't want to waste your time. Now that you understand what an uptrend is all about, let me just quickly explain what a downtrend is all about. Now, but before I explain the downtrend, I missed out something. Now, remember I said the market started to make a low here. Then after that low, it went up, created another low. Why? Because the market went up and came back down low, right? But that low did not get to the previous low. Then the market created another low, but that low is higher than the previous low. And that is why it is called a higher low. And then you will see that the same thing, continues to repeat itself, so you start to see series of lower lows, just the same you were seeing series of higher highs. So what this one is just telling you is that when you get to the market and you began to see series of higher highs and higher low, what you will say in that direction, or sorry, in that kind of situation, is that the market is actually uptrending. Now, in this particular situation, you are convinced that the market is an uptrend, basically. And then what you do in an uptrend, in this situation, is that you look for buy opportunities. You don't look for sell opportunity. In the same vein, you come to the market and you see something like this. You see price moving like this, and it's downtrending, basically, right? It's moving from a high price down to a low price here. When you start to see this kind of pattern in the market, you know that the market is actually downtrending. Now, this uptrend is called a bullish market. This downtrend is called a bearish market, meaning that in this situation of an uptrend, the buyers are in control. And in this situation of a downtrend, the sellers are in control. So this is a market that is actually downtrending. But what can you see in this particular market different from the one I explained earlier? Now look at something very interesting. Price was moving down, went up, could not get to the previous high, came down, created a low that is lower than the previous low, came up, could not get to the other low that was created. So you see what the market is doing. It started from a high, then created a low, and then moved from that low, tried to move up, but could not get to the previous high. Then you say the market is, has done a higher low. Now, after creating that higher low, the market came down or came below the previous low. Then what you will say here is that the market has made a lower low. Why is this a lower low? It is a lower low simply because the new low that was created is lower than the previous low that was created after the high. And then you continue to see the same thing over and over again, where the next high is not as high as the previous high. Then you call each of the new highs lower highs, all right? And each of the new lows, lower low. This is simply what, downtrend is all about. This is simply what downtrend is all about, guys. This is simply what downtrend is all about. Please don't let anybody deceive you. The market only moves in three ways. It's either the market is moving upward, or is moving downward, or is making a sideways movement. What I'm explaining right now, I've actually explained, an uptrend. Now I'm explaining a downtrend. Now, generally speaking, what this one is telling you is that anytime you get to the market and you see the market making series of higher lows and lower lows and lower highs, then you say the market is downtrending. This is actually a downtrend in the market. This is actually a downtrend in the Forex market. And then what do you do when you see the market downtrending? What do you do, guys, when you see the market downtrending? Pardon me, let me remove this. What do you do when you see the market downtrending? When you see the market downtrending, what you look for is a sell opportunity. Now, the third kind of market that you can see in a Forex market is the one I'm about to describe. Now, look at this. It's different from the first that I described and the second that I described. Now, if you look at this, what you will see is that market is not going past a particular range. market is not going past a particular range. The price in the market is not going past a particular range. What that means is that the market will touch a resistance and then come back to the same support, go back to the same resistance, come back to the same support, and then go back to the same resistance, come back to the same support, and all that. Now, what do you do when you see this kind of thing? You know, if you really want to play safe, my best advice for you, this is actually called a sideways movement or a ranging market. And how do you deal with a ranging market or a sideways moving market as opposed to what you do when you see an uptrend, a downtrend? In this kind of situation, you wait. You actually wait. You wait for break out of range. Now, what do I mean by that? You wait for breakout of range. That breakout is actually telling you, you know, that the market is going in the direction, you know, that the market has broken to. If the market, breaks upward, you know, the market wants to move up. If the market breaks downward, it means that the market wants to continue to sell. Now, let me also tell you this, you need to be very careful. There are cases where there are fake breakout. I'm not going to talk about that in this particular video. I'm also going to make a totally different video, you know, for you to be able to identify what a fake breakout is all about. But just for the purpose of understanding, you know, market structure, I've just explained to you, you know, that there are three types of market, and those markets are, we have an uptrend, we have a downtrend, and, you know, we have a sideways or a ranging, a sideways moving or a ranging market. Once you have this solid understanding of how the market, you know, moves, and you know what you do in each of the scenarios, then your trading journey has just started. So this particular point in time, I think I have done a bit of justice to what you know, market structure is all about. Now, the next thing I want to really talk about, I think I should actually talk about, before I come back to order block and fair value gap, let me talk to you guys about what change of character is. You know, guys, pay attention to this. Pay attention to this. So let's assume that you are in an uptrend, right? Our market is doing something like this. It's going up, making some retracement, going up, making some retracement, go up, and like this. Now, every time market is moving like this, market is actually changing direction and breaking structure. But be careful, I want to explain to you precisely what the difference is between a change of character and a break of structure. They look similar to a lot of people. I'm going to make another video to talk about, you know, internal range liquidity and external range liquidity. As a matter of fact, before I can even talk about external range liquidity or external range liquidity, I need to even talk to you about what liquidity is all about. But please watch out for my other video. If you are watching this video, please like this video and subscribe to our YouTube channel, so that it is important for you to get notification, you know, and press the notification button anyway, so that you can get notification anytime we release a new video. So what am I trying to explain here? Now, if you look at this, anytime market wants to go up and has made that upward, that is all upward movement, there is always a break of the previous high. I explained in my, you know, previous topic in this same video that when a market is making series of higher highs and higher lows, you know, the market is actually uptrending. So the market got to this particular high, came back, but could not get back to the previous low where it started. Then it created another low here. After creating that low, it moved up and broke the previous high. Now, after getting to a particular point in time, a particular price point, it came back, you know, retraced, and then, you know, went up. Now, you see what happened here. Market actually broke another structure. That is, it broke the previous high. So now, as a trader, whenever you are trading, when you see price at this point breaking structure and you begin to see some slow momentum here, it is not the time for you to enter the market. You need to wait for price to retrace, especially when the uptrend has been established. Otherwise, you will need to, sustain, some injury, what I will call injury. That means you will need to see, draw down, and God help you, your account balance cannot carry it, or you're over trading, you blow your account, basically. Sometimes I tell people that we are at the architect of our own problem when we are trading in the forex market. It is important for you to learn some of these things so that you don't continue to make the same mistake you've always been making. Now, what am I trying to explain here? So you get to the market, you see something like this, and all of a sudden you just see the market, try to do something like this. It came down and closed below the previous higher low. It came down and broke below the immediate previous higher low. Now, what do you think has happened here? Now, what has happened here is that there is a change in the direction of the market, which is yet to be confirmed. But that change in direction of the market is only confirmed, by a change of character. And that change of character actually happened here because the previous low was taken out. And taken out means it is the body of the candle that actually closed below the previous, not a spike. If price spikes down and the body still closed above, the previous, the previous higher low, then it is not a change of character. It is not a change of character. Now, this is where you guys need to be very careful, right? As a trader, until you see that market makes another move, right? This is just giving you an heads up that the market may be about. Nothing is guaranteed in the forex market. This is just telling you that the market may be about to change direction. And until you see that price find it difficult to get to the previous or the highest high, and that came down and came below the previous low that was created here. That previous low that actually took out the higher low that was created when the market was uptrending. This is now a complete change or break of structure. They look so much alike, but you require confirmation for you to call it a break of structure. You require confirmation for you to call it a break of structure. Now, this is simply telling you that this is a complete, break of structure. This is a complete break of structure. This is a complete break of structure. Why? It is a complete break of structure because a change of character, a change of character was succeeded by the market trying to get and break the previous high. Remember, unlike these cases, the market will break every new high and then came back and break another new high. Okay, but in this case, price actually closed below the previous higher low, but could not get back, to the highest high that was created here. Instead, it got back to this place, which is lower than the highest high, and then came down and still took out the previous low that brought about the change of character that took place here. This is a complete break of structure. A lot of us miss these things together, right? A change of character is simply an indication that the market may be about to change direction, while the break of structure is confirmed by the fact that market is unable to make, a higher high that is higher than the highest high that was created in the market. This is what some people call bias exhaustion in the market. So when you see that has happened and a new low has been created, another lower low has been created, then the market has simply changed from an uptrend to a downtrend. And that is what a break of structure is all about. Just to simply recap, market moves in 3 different directions. Market can move upward, and whenever the market is moving upward, there will be a series of higher highs and higher lows that will be created. And in that case, you say the market is uptrending, and what you do is to look for buy opportunity. The reverse is the case. When you see markets making series of higher lows and lower lows, you say the market is downtrending. And whenever the market is downtrending, what you do is that you look for sell opportunity. I will always advise my students, do not trade against the trend. Trend is your friend. Always trade in the direction of the trend. Do not say, oh, yes, I know the market is uptrending, but let me quickly sell or make money from this retracement. Yeah, you can do it. Professional traders do it. But if you are doing that, you need to manage your risk very, very well. The best way to always continue to, to win in the Forex market and increase your win rate is to always trade in the direction of the market. Now, the next thing I want to talk about, which as part of my summary, is sideways movement. I've told you guys that it is better to play safe because when the market is ranging, yeah, you don't know whether the market wants to go up or wants to go down, so you wait for a break out of that range. So if the market breaks upward, definitely it means that the market wants to buy. But you don't just jump into a buy because the market has broken upward. I told you earlier that there is a possibility that the market might fake out. Probably the market actually has an intention to actually go down, and it's probably still seeing some liquidity above the resistance that need to be taken out. Liquidity is money. Liquidity is simply people's stop loss above resistance or below support. So market can do a fake out, and deceive people that it wants to buy and then sell. What the market is doing is actually to take out the external liquidity. Guys, just pardon me, I'm going to do a totally different video explaining what liquidity is all about and the different types of liquidity that we have in the market. Okay, so what I would like to say here is that just understand the direction of the market anytime you get into the market, and then know what to do when you see the market uptrending or when you see the market downtrending. And my best advice for anyone who is just trying to learn how to trade, you are not a full-blown professional, do not trade a ranging or a sideways moving market. I've also gone ahead to explain what the difference is between change of character and what break of structure. Now, if you understand all of these things, then it now becomes easy. Now, we have learned market structure, we have learned change of character, we have learned break of structure. Now, let's quickly look at what we mean by order block. And I'm still going to use the same explanation of an uptrend and a downtrend to explain what an order block is all about. We have order block. Order block are simply institutional reference point where large traders, large institutional investor place block orders. Block order means large volume of order, basically. Whenever the market is uptrending and retracing and coming back to to retrace, and probably even if the market is moving upward, there will always be, if you look very closely at the market, there will always be either a bearish order block or a bullish order block created. Everything I'm doing now is just to explain the theory. I will probably go to the, if I have a bit more time, I'll probably go to chart and just explain to you how these things actually play out in the market. So let's see this basically. So the market is uptrending in this situation, making higher highs and higher lows, higher highs and higher lows. Now, if you look very closely, yeah, most of the time, this is how far the market will eventually move. Now, after you see a low, if you look very closely, there will always be an order block. Yeah, I told you earlier, the general definition of order block is just, that zone where institutional investors or smart money, let me use the word smart money, yeah, where smart money actually plays large order in blocks. And that is the point where a lot of retail traders get hot in the market. So what you will see is that when you get to the market, you will see that around that place where the market tried to retrace, you will probably see something like, if it's, let me just say for the purpose of this explanation, you'll probably see something like a green candle here. Yeah. You will probably see something like a green candle around, that point, here, before you start seeing the red candle doing that retracement, all right? Before you start to see that red candle doing that retracement. Now, this is the other block. Now, this green candle, and please, with no particular reference to colors, you can use any color of yours, but for the purpose of this explanation, I will use green for bullish and I will use red for bearish. Now, around this place, before you will now start to see series of red candles coming down to retrace at that point. You see series of red candles coming down to retrace to go back and pick liquidity for continuation to the upside. You probably see, something like this. You see candles, red candles coming like this. Pardon me, I'm just trying to paint the picture for you before going into the live market to explain what I'm about to tell you, basically. So what you will see is that you'll probably just see, some red candle getting to this point, and then at this point, right, you will now see a red candle, the last red candle around this point, all right, pardon my drawing, around this point, after a series of red candle, then before you now start seeing some large green candles, going up, basically. Before you now see some green candle, that is the bullish candle for the purpose of this explanation, going up, basically, yeah, to create another high and break structure, all right? To create another high and break structure to the next high. And then around this list, you will probably see the last green candle before you now see, so what I'm just trying to paint here is that if you look around the retracement areas, right, basically, you would always see a green candle before the large number of even single, red candle trying to go back to retrace, to make some kind of changes in the direction of the market. Now, what am I trying to explain, guys? I'm trying to explain to you guys that, in the Forex market, yeah, you need to know the reading of the market. And what I'm trying to explain to you right now is the reading of the market. So what am I trying to see? You see an order block here. This order block, this whole area here is called the bullish order block. This is the bullish order block. Sorry, the bearish, pardon me guys, it is the bearish order block. This is the bearish order block. Bearish order block. Where is it the bearish order block? It is the bearish order block because that is the last bullish candle that was created before the fall in price. So to define what order block is all about, a bearish order block is simply the last bullish candle before a downtrend. It is simply the last bullish candle before a downtrend. So what am I trying to say here? When you see this old zone, means that this is the area with which price will start to show some possibility of a downtrend. before coming back to this place. That is a bearish order block. I like to mark my bearish order block red. All right. Don't forget, the candle that you will see here is not a red candle. It's not a red candle. It's a green candle. Then you now begin to see series of red candle, that is bearish candle coming down this way, coming down this way, coming down this way, until that retracement is completed. Now, vice versa, when you look at this area, you will see the last the last red candle, right? Now, do not forget, just the same way I explained, there is always a red candle here, signaling, the other block, right? That red candle is the last red candle you will see around here before you see this upward movement. Now, I always like to mark or color my bullish order block green, just for the purpose of differentiation. All right. Now, let me make this a bit lighter so it's not too dark. So this area here is called our bullish order block. This is a bullish order block. This is a bullish order block. Now, what am I trying to say here? Anytime price is moving upward, the expectation is that when price is moving upward, when it gets to a bearish order block, price is expected to react and show some sign of reversal. And when price gets to a bullish order block, it's meant to touch the bullish order block and make some reaction here and then go back. And sometimes, depending on the momentum of the market, it can break the bearish order block and continue to make an uptrend. This is what the bullish order block and the bearish order block is all about. Now, what have I said? I said anytime you are seeing an uptrend, always look around, that retracement area. Always look around the retracement area. You will always see either a bullish order block, or bearish order block at the point where price is trying to make retracement. Let me go back to what I was trying to explain. All right. So I've explained to you what market structure is all about. I've explained to you what order block is all about. Then talking about bearish and bullish order block. I've explained to you, change of character and break of structure. So I'm actually left with explaining what fair value gap is all about. And then after that, I will then go to the live chart and explain to you how you can use that to your advantage. I'm probably just going to be taking one example now because of time, and then in my subsequent video, I will take another example. But what is important for you is to know how to use all of these 5 knowledge, to take entry in the Forex market. Now, let me just quickly describe this. Basically, what I will say is that fair value gaps are created as a result of inefficiencies in price movement or imbalance in the, between the buyers and the sellers in the market, and it's always a 3-candle price action, basically, that creates that, either on the bearish side or on the bullish side, that creates, that, fair value gap in the market. Now, let's go to a live chart to explain this. I'll probably just go to a live chart to explain this. Now, what you will see is that price would always break structure. Or the first thing you will see, when you want to identify that imbalance, I'm looking for a much perfect one to use. for the purpose of explanation, remember that the market is not picture perfect. So I'm looking for something that is fantastic. Now, look at this. Let me just play back a little. Let me reduce the data. Now, what can you see in the market here? I'm trying to explain. When you see price moving up and creating what I would call a fair value gap, right? Price is actually, that fair value gap is happening as a result of inefficiencies in the movement of price, or inefficiency in the negotiations between the buyers and the seller. Now, what you can see here is that the highest high ever before this bullish candle actually broke that point was at 505. I'm just giving you this example. Now, what then happens? You see that price broke and then price never came back, just kept going up. So you see that the first candle that broke price here is actually this blue candle, and then followed by this and followed by this. Now, remember, I said that it is a 3-candle price action. So I will look at this particular candle, and this particular candle. Normally in the market, all right, the spikes in prices are supposed to be connected, by some sort of, horizontal line. And I'll give you that typical example here. If you look at this, I'm putting my horizontal line on this spike. You will see that this spike here and this spike here is connected by the yellow horizontal line. But let's go back to the example I'm trying to create, all right? For the purpose of explanation and clarity, let me remove the previous one I used for example. So if you look at this area, the first candle that broke the orange horizontal line, you see a second candle and you see a third candle. If you look very closely, you will see that the eye of this candle is this. Let me use another color and let me change the thickness, right? Let me use a red. Now you can see this red is sitting on the eye that is the spike or the wick of this first candle that broke this particular price. And then you will see that this one that I'm just drawing now is sitting at the low. So in a movement, in an upward movement, it is the gap created here between the eye of the first candle that broke structure, or that created a change of character, or that gives the heads up in the market that the market may be about to be uptrending. In the high of it is where I'm putting the first red candle, and the low of the third candle, leaving the second candle in between, is this second candle. If you look very closely, if I expand, a space was created here. That space that is created is what we call, fair value gap. At some point in time, the market would always come back to close a fair value gap. It might continue to go up for as long as it wants, but just know that means that fair value gap that was created here, let me write it in there. A fair value gap was created here. That fair value gap will always get closed at some point in the course of, negotiations between buyers and sellers. So for me, when I see a 3-candle action price like this, the next thing I'll be looking out for is there an order block? Because I've explained an order block before. Now, remember I told you that a fair value gap that has, another block that has a fair value gap close to it or around it or embedded in it is actually a valid one, basically. Let me just put it that way. All right. Now, the other thing you also need to know is that when you see a fair value gap, I will stop at explaining the bullish because of my time. In my next video, I will explain the bearish. When the market is bearish, a lot of people or a lot of traders refer to it, as imbalances. They look at fair value gap when there are imbalances in the market. But I'm going to stop here so that I can just quickly show you an example. Now that I've explained what an order block is and what a fair value gap is. And I've explained, break of structure, change of character, uptrending market and downtrending market and the sideways movement. So let's just use this example and round up this video. So what I'm just trying to say now, when you see a thing like this, the next thing you want to see is how is the market going to, what is the market going to do? As you can see, the market came and closed the fair value gap first, and then went back up a little, then came back into the area where you have the order block just above it, and then continue to uptrend. For the purpose of, of time, I'm going to stop this particular video here, and I will hope that you will subscribe to our YouTube channel for more videos. You will like and subscribe to our channel, and you'll get to see subsequent videos that we'll be coming up with in Finspot Academy. And I'm sure that this video has actually blessed you. You have learned one of two things, from what is fair value gap, what is order block, what is change of character as opposed to break of structure, and how to use those knowledge, to actually, take advantage of the market. I am going to do another video as a rejoinder to this particular video, just looking at examples of everything that we have learned, so that we can see how we can actually use these 5 simple knowledge, that I've actually mentioned, and talking also about institutional reference points such as value gap and order block. Until next time we'll catch up on another video, I say goodbye. Thank you.